You woke up and got a free airdrop worth a few thousand. Hooray, now pay your taxes. But if you lived one border over, the bill would look totally different or arrive a year later. That's the silent nightmare of crypto staking and airdrops. Timing, classification, and residency can flip your tax outcome from painless to painful. Today, I'll break down how the United States, Portugal, and Germany treat staking rewards, airdrops, and other DeFi yields, and how to avoid the most expensive mistakes. The big idea behind all the country rules is deceptively simple. The taxman wants to know when you truly have control and what you received. Income or an asset with a cost basis you'll later sell. The devil lives in the definitions of dominion and control, holding period, and whether your activities look like investing or a business. Keep that in mind, because the same click can mean 3 different tax stories depending on where you live. Ready? In the United States, the rule is blunt, almost refreshing in its cruelty. When staking rewards reach the point where you can transfer or sell them, when you have what the Internal Revenue Service calls dominion and control, they count as ordinary income at fair market value in United States dollars at that moment. It doesn't matter if you keep the tokens. It doesn't matter if the price drops 5 minutes later. Income first, feelings later. Then, in a separate chapter of your tax saga, when you eventually sell those same tokens, you calculate a capital gain or loss against the cost basis set by that original income value. Airdrops follow the same logic if they become usable right away. The Internal Revenue Service has said it clearly in its guidance on hard forks and airdrops. If a hard fork is followed by an airdrop that you actually receive and control, that's taxable income in that year. Your basis in the airdropped asset is the amount you just recognized as income. When you sell later, you compare the sale price to that basis. This is why phantom income shocks people. The token's price can dump after you've already booked income at the higher receipt value. It's like being charged for a celebratory cake that someone else ate. There are 2 high-stakes reminders that American filers can't ignore, and this is where one more definition matters. Each year, individuals file their annual United States income tax return on Form 1040. That's the main personal tax form, the cover sheet of your financial year, the one that asks the big questions and pulls in your schedules and attachments. If you pay United States tax, you've met the 1040. If you haven't yet, you will. On today's 1040, one line asks if you dealt with digital assets. You must answer yes or no. And the Internal Revenue Service even provides examples, airdrops, staking, and other receipts to help you decide. Ticking neither box is not a life hack. It's an invitation to extra attention. Then there's the reality that reporting is expanding. The Internal Revenue Service has been rolling out new digital asset reporting rules and publicly reminding everyone that enforcement is ramping up. If you sell or exchange, assume platforms will report more and more. Translation: the maybe they won't notice era is over, and your spreadsheet is not a cloaking device. For example, you stake 12 Ethereum. On June 15th, rewards of 0.4 Ethereum become transferable, and Ethereum trades at 3,200 United States dollars. You've got $1,280 of ordinary income right then and there, and your basis in that 0.4 Ethereum is now $1,280. Sell that slice later for $1,000? That's a $280 capital loss. Sell it for $1,600? You've got a $320 capital gain. Income first, then a separate capital result. Or picture a buzzy protocol airdropping you 500 tokens at a $2 listing price, immediately transferable. You recognize $1,000 of ordinary income at receipt. That $1,000 becomes your total basis. If you sell later for $600, you've got a $400 capital loss. If you sell for $2,500, there's a $1,500 capital gain. Simple on paper, chaotic in practice, because the operational pain is timestamps and fair market value capture. You must establish the exact moment you gain control and the price at that moment. Most retail wallets don't preserve those facts, and bridges, wraps, and restakes turn one neat story into a choose-your-own-adventure novel. If you can't prove when control happened and what the United States dollar price was, you're negotiating your audit with vibes. Let's not do that. And now, just when you think this can't get worse, we cross the Atlantic. Portugal arrives like a postcard promising sunshine and pastéis de nata. But the tax rules since 2023 come with grown-up footnotes. The country still has a crypto-friendly flavor, yet it's clearer and tougher on short-term activity. If you sell crypto held for less than 365 days, that short-term capital gain is generally taxed at a 28% flat rate for individuals, unless you choose to aggregate with other income. hold for 365 days or more, and many disposals become exempt, provided you meet conditions like not involving blacklisted jurisdictions and staying in the lane of a private investor rather than a business. Here's the twist that catches people. Income type flows, like staking, mining, and often airdrops, can be taxed as current income when received. That's separate from the capital gains bucket. In other words, the 365-day magic doesn't erase the fact that new tokens dropped into your wallet might be taxable as income if you control them. Local guidance and professional summaries repeat the same message. Reclassification depends on your pattern of activity, and if you cross into the territory of a business, rates and obligations change. Sunny weather, yes. Sunny assumptions, no. Let's walk it through with a simple picture. You're a private individual, not running a business. On March 1st, staking rewards of 200 units of Token X hit your wallet, immediately usable at €1.50 each. The 300 euros is typically income for that year. You then hold those 200 units for 370 days and sell for €2.20 each. The disposal may be exempt because the holding period is over 365 days and you meet the conditions. But the income you recognized on receipt the prior year still counts. It does not vanish with time, like an embarrassing tweet. The Portuguese playbook also hides a few practical speed bumps that are small enough to miss and big enough to hurt. You need to track holding periods per lot across borders. If you bought before 2023, there's a transitional rule that counts prior holding time under Article 10 of the IRS Code, and the official portal mentions it. You should avoid drifting into business status by accident. High volume and a systematic approach can move you into Category B income, with different accounting and social security implications. Local tax authority notes and professional bodies discuss thresholds and regime changes, and you don't want to discover them by letter. And you should be careful with blacklisted jurisdictions and broker locations, because some exemptions depend on where your counterparty sits and whether the jurisdiction is cooperative. Portuguese banks and financial portals love reminding filers about the right annexes and the extra forms foreign brokers can trigger. The hook before we head north is this. In Portugal, 365 days can flip capital gains from taxable to exempt, but staking and many airdrops still bite right now as income. If you plan on locks without planning cash flow, you've basically scheduled a surprise party for your tax bill. Speaking of surprises, Germany has an update that changes how one very specific airdrop might be taxed. Germany has turned crypto taxation into a cookbook that keeps getting new chapters. The first major write-up dropped in May 2022, and another update landed on 6 March 2025 from the Federal Ministry of Finance. The new circular, including an English courtesy translation, refines how airdrops, hard forks, staking, lending, and the line between private assets and business are treated. If you're a private individual, many crypto disposals fall under private sales rules with a 1-year holding period. Rewards and airdrops, however, can be taxed as other income on receipt, depending on the facts of how you got them. And then comes the headline twist that raises eyebrows. Some airdrops in specific private asset situations can be valued at €0 when you receive them. That means no income at receipt. Instead, when you dispose of the airdrop tokens, the entire proceeds may be taxable if you sell within the holding period. The key is whether you rendered any service or took steps that look like compensation. The 2025 letter from the ministry spells out the branches in painstaking detail, which is bureaucratic for read this twice. Consider you receive an unsolicited airdrop simply because you held token Y. You didn't perform a service, there was no claim action that involved a quid pro quo, and your facts are consistent with private assets. On receipt, €0 is recorded. 9 months later, you sell for €1,800. Because you sold within 1 year, the €1,800 can be taxable under the private sales rules. If you had held past 1 year, that disposal might be tax-free in the private asset context, subject to the usual conditions and thresholds. By contrast, staking stays down to earth. You stake 5,000 units of token Z and accrue 250 reward units that become claimable monthly. Each time they become claimable, those rewards are other income, based on fair market value at that moment. When you sell the reward units later, the private sale rules apply with a fresh 1-year clock for those units. Germany wants receipts, and not just the payment kind. The practical difficulty is documenting the facts that separate "I did nothing but hold" from "I performed a service or took steps that constitute consideration." Did you render a service? Did you have to perform an action to receive value that looks like a compensation event? Those details push transactions into other income today versus private sale later. And there's a comforting coda. Fears that staking would stretch the holding period to 10 years have been parked for private investors. The 1-year period keeps center stage. The zero-basis airdrop pathway can be elegant, but it's not a costume. It only fits when the facts fit. The first universal trap is thinking locked equals not taxed. If rewards are truly locked and you cannot transfer or dispose, many systems wait to recognize income until control exists. But control is a facts test, not a vibes test. If a centralized platform credits a balance, you can sell internally. Yes, even if you haven't withdrawn on-chain, agencies often consider that control. Capture evidence of unlock events and first transferability. In the United States, this lines up with the focus on dominion and control. The second trap is the airdrop basis flip. In the United States, airdrops you control create ordinary income at receipt, and that value becomes your basis. Sell later and you compute a capital result against that basis. In Germany, a subset of private asset airdrops may have zero value at receipt, which kicks taxation to disposal if you sell within 1 year. Same airdrop, radically different math. The third trap is the DeFi Legos effect. Every wrap, liquidity pool mint or burn, claim, swap, bridge, and restake can be a disposal or a receipt, depending on the jurisdiction. Your net profit and loss might be flat, but your ledger can still be fireworks. If your personal records don't match exchange exports or on-chain explorers, you'll spend hours reconciling, or worse, guessing. The fourth trap is residency and split-year moves. If you move mid-year, you can end up with 2 sets of rules and filing calendars. Your tax home at the moment you received an airdrop or when staking became claimable can swing outcomes. Keep a timeline that shows entry and exit dates, residence certificates, and evidence of where you were tax resident when each event happened. The fifth trap is the siren song of passive income marketing. User interfaces love to call yields passive, but labels don't decide tax character. If it walks like interest or looks like payment for validating blocks, many systems will treat it as ordinary income at receipt. Don't let a slick user experience make you ignore the income bucket while you obsess over capital gains. So, what kind of record keeping actually saves you? Not just your conscience? Start with wallet timelines. For each address and protocol, log when you received, when you unlocked, and when you first had transferability for staking and airdrops. Add the fair market value capture for each income event. Store the United States dollar or euro price at the exact receipt or claim time. In the United States, that number is your income. In Germany, even when pursuing the zero value pathway for certain airdrops, valuation evidence helps prove whether you received anything of value at receipt. And it's still useful context later. Track lots carefully. In Germany, expect first in, first out for private assets. In the United States, specific identification can be allowed if your records are immaculate. Otherwise, many platforms default to first in, first out. For complex DeFi, write human notes that connect the dots. Deposit to liquidity pool token to rewards to restake, because software sees transactions, not stories, and auditors read stories. Above all, maintain a residency calendar. A month-by-month log of where you were tax resident is not overkill. It's the difference between clarity and chaos when your life crosses borders. If you like strategy levers that are both legit and effective, here are the ones that matter without turning you into a full-time tax acrobat. Control the income date where the protocol allows it. If you can choose when rewards become transferable by claiming less often or timing unlocks, you are indirectly choosing your income date, which can change your marginal rate and your cash flow. In volatile markets, 48 hours can mean recognizing $10,000 of income versus $4,000. Just remember that not claiming doesn't help if the platform already treats the balances under your control. Respect holding period magic. In Portugal, the 365-day threshold can flip capital gains outcomes from a 28% tax to exemption for private investors, but don't assume it erases income at receipt. In Germany, the 1-year private sale period still matters after the 2025 update. It's central to whether a disposal is taxable. Airdrops with zero receipt value can be a graceful route, if your facts actually match the ministry's criteria. Consider bundling disposals on purpose. Instead of a drip of tiny sales, plan exit windows. You'll have fewer line items, cleaner basis matching, and better rate optimization in the United States, where long-term rates can be lower for holdings over a year. Avoid stumbling into business classification. High-frequency activity, public marketing, and systematic operations can reclassify your activity in Portugal and Germany. changing rates and compliance. If you are operating like a business, make it deliberate and set up proper books. And for United States compliance hygiene, answer the digital asset question on Form 1040. Expect more third-party reporting and keep documentation so clean that future you sends past you a thank you meme.